Welcome to the Deep Dive. Today, we're taking a high-altitude look at Textron, a company that, quietly builds half the U.S. military's next-gen helicopters and makes your neighbor's golf cart.
Right. And our mission today is to figure out why those two seemingly unrelated lines of business are now fundamentally incompatible.
Exactly. This isn't just about reviewing their recent Q3 2025 earnings.
No, not at all. We are witnessing a monumental strategic realignment happening at the very top of this huge conglomerate.
And the changing of the guard, it's more than just a personnel shift.
Oh, absolutely. It's a deliberate tactical signal about where this, $14 billion enterprise is being steered next.
Okay, so let's unpack that, this huge shift right at the top.
Right.
The big news is Scott Donnelly, after 17 years, is stepping down as president and CEO.
A very long era. He's moving to executive chairman effective January 4th, 2026.
He's been CEO since 2009. The board seemed to really credit him with developing internal talent.
They did. And this transition is clearly set up to be a smooth handoff. Donnelly's sticking around in an advisory role. But the key insight for us, for you, is who's replacing him.
And that's Lisa Atherton. She's the new president and CEO, and she's also joining the board of directors.
Right. And Textron called it a comprehensive succession planning process, which basically means this move has been choreographed for a while.
Now, her previous role is what really tells the story here, isn't it?
It is the critical clue. She was the driving force behind the Bell helicopter segment. That's the biggest, highest performing part of the whole business.
So her promotion is a signal to the market.
A loud and clear one. It says Textron's priority, its future, is now inextricably rooted in the defense sector. High growth, high margin defense.
That makes perfect sense. I mean, Bell is where the multi-billion-dollar generational contracts live. But wait.
Go on.
If she's coming from the military side of the house, does that mean the other segments like commercial aviation, Cessna, Beechcraft, are they at risk of being neglected?
That is a legitimate concern. It's the tension the new leadership has to manage. But her selection really suggests that the priority is that premium valuation you get from being a defense contractor.
So other segments might be, optimized for cash or sold off?
Exactly. It really feels like the military side of the house is now steering the entire ship.
Okay, so let's pivot to the financials she's inheriting. Q3 2025. It was a classic mixed picture.
It really was. A beat on profit, but a miss on revenue.
Total revenue for the quarter was $3.60 billion.
Right, and analysts were looking for $3.67 billion, so that's a 1.9% miss. But the top line still grew a solid 5.1% year over year.
But the bottom line, that's where they really performed. Adjusted EPS hit $1.55.
And consensus was what, $1.46? So that's a big 6.4% beat on profit. It just suggests really disciplined cost control. They're executing.
And management seemed confident. They reiterated their full-year guidance.
They did. The midpoint for 2025 adjusted EPS is still $6.10, right in that $6 to $6.20 range. For a company with a market cap around $14.16 billion, that stability is key.
Okay, but here's where it gets really interesting for anyone looking at this company long-term. The backlog.
Yes. This isn't just revenue. It's their competitive moat. It's certainty.
And the word colossal really is appropriate here. The backlog surged to an astounding $19.1 billion by the third quarter.
$19.1 billion. To put that in perspective for you, that's almost 5 years of revenue visibility for the Bell segment alone. That locks in performance, regardless of short-term economic bumps.
5 years of guaranteed work. That's massive.
It is. And the breakdown is key. About 76% of that is expected to be recognized as revenue through the end of 2026. So this isn't theoretical, it's happening.
Let's dive into the segments then, see who's driving this $19 billion figure. And, no surprise, we start with Bell, the new CEO's old stomping grounds.
The growth engine for sure. Bell's military revenue increased sharply, and it's directly tied to a few key programs. We're talking about the MV-75 program, but the real needle mover is FLRAA.
The Future Long-Range Assault Aircraft for the U.S. Army.
That's the one. It's a massive, multi-decade replacement program for the Black Hawk helicopters. It's a generational investment.
So securing FLRAA, this wasn't just another contract to win?
No. It positioned Bell as the go-to partner for the next generation of American military vertical lift. It basically guarantees a revenue stream for decades, not years.
And that kind of huge development program, it brings us to a really crucial point about their margins, right?
Precisely. It relates to how these huge development contracts are structured.
They're not fixed price.
Exactly. Management highlighted that most of this work is structured as cost-plus contracts. Now, for you listening, this is huge. A fixed price contract means Textron assumes all the risk of delays and cost overruns.
But with cost plus.
The military reimburses them for costs incurred, plus an agreed upon margin. It fundamentally changes the risk exposure for Textron. It significantly reduces their financial downside, which is a major factor in that Q3 EPS beat we just talked about.
So lower risk, predictable, almost guaranteed margins.
You got it. It's perfect for supporting the stock valuation during a big leadership transition. And, outside of military, Bell is still selling commercial helicopters like the 429 and the 505 Jet Ranger X.
Okay. Moving to Textron Systems, the other defense segment, management is saying they're hitting a new growth phase.
That's the narrative, yeah. They're securing some big new contracts, things like the ship-to-shore connector and mobile strike force vehicles. It seems like the strategic focus there is starting to pay off.
Right. Now, Textron Aviation. Cessna, Beechcraft. This story feels less like a boom and more like a determined recovery.
It is a recovery story, definitely. Though the fundamentals in civil aviation are very strong. You're seeing high fleet utilization, which means aftermarket revenue parts, maintenance is growing nicely. And that's high margin stuff.
But the manufacturing side took a big hit.
A significant one. Deliveries were really hindered by that IAM union strike, which ran from September 21st to October 20th, 2024, a whole month of lost production.
And what was the tangible impact of that?
Well, it directly lowered their output. They only delivered 151 Citation jets in 2024, down from 168 the year before. Turboprops were down too. That's lost revenue they had to scramble to make up.
And they're trying to move past that with new products.
Absolutely. The ramp up of the new Cessna Citation Ascend is key. First customer delivery was in January 2026, and they're citing things like Starlink connectivity as major selling points to keep orders coming in.
So defense is booming, aviation is recovering, but the strategic realignment, it requires sacrifices.
It does. And the flip side of this pivot is the aggressive cleanup happening in the industrial and the aviation segments. This is the definition of pruning dead weight.
It seems like this is the definitive part of the new strategy.
I think so. The industrial segment has been a persistent drag. Lower revenues, weak demand in power sports, think Arctic Cat snowmobiles, and things like Ezio golf carts. These are consumer businesses that just don't fit the new identity.
And management has clearly lost patience.
Completely. They initiated a strategic review, announced an indefinite pause of power sports production. I mean, they are actively pruning. If your focus is defense contracts and private jets, why are you holding on to a golf cart company?
Good question. And speaking of things that don't fit, what about their electric aviation ambitions? The aviation division they created in 2022.
Right, after they bought Pipistrel. Well, that division is now being dissolved.
Dissolved entirely.
Its activities are being integrated or folded into the main Textron aviation segment. This is a massive strategic shift. They're moving away from a standalone, high-risk EV moonshot.
So they're prioritizing proven, stable revenue.
It suggests they are streamlining the entire portfolio to focus capital and talent on the highest return segments, the ones driving that $19.1 billion backlog. The message is clear. Clean up the balance sheet, boost the margins, and become a defense powerhouse.
So when we put it all together, what does it mean? It really sounds like Textron is consciously ditching its historic identity.
That is the big takeaway. It's a decisive shift. They're moving towards being a focused aerospace and defense player, doubling down on Bell and Textron systems, and aggressively cleaning up everything else.
That's powerful clarity. But even with that incredible backlog, what are the risks management is worried about?
Even the strongest company has headwinds. They pointed to three things. First, supply chain bottlenecks are still a constant problem. It delays production of everything from jets to helicopters.
That's an industry-wide problem, though. What about defense-specific risks?
Second, they're exposed to the timing of government decisions. Politics. A major contract can be slowed down or even terminated. Your biggest customer is the U.S. Army, and you don't control them.
And finally, the universal challenge, talent.
Exactly. Attracting and retaining skilled engineers, manufacturing experts, cybersecurity professionals, it's fiercely competitive. Execution on a program like FLRAA depends entirely on having that world-class talent.
Which brings us to our final segment where we wrap this all up.
This is not financial advice. This segment is for informational and entertainment purposes only. We are not offering personalized investment recommendations.
But based on everything we've analyzed, the new CEO, the defense pivot, the active pruning, we can definitely craft an outrageous but plausible scenario here.
You can. That $19.1 billion backlog makes the industrial segment look like pure dead weight on their valuation.
So if you connect the dots, Atherton's background, the strategy,
Right.
the simplest, most powerful move is to just shed the industrial segment entirely. Easy go, Cotex, all of it.
It just gets rid of all that consumer demand volatility that's been plaguing the results.
So here's the trade idea. Buy long-dated call options, targeting a massive share price increase, and you're banking on a pure play premium.
The scenario is highly plausible. Textron successfully divests the entire industrial segment for cash in the first half of 2026, right as the new CEO settles in. This move would instantly boost margins, clear out the volatility, and let them focus on what they do best.
And the market would be forced to re-rate the stock. They're no longer a clunky conglomerate. They're a true defense pure play.
Which would justify a premium valuation far exceeding where they are now.
A great trade idea needs a clear narrative shift, and the narrative here is deafening. Defense first. So, considering the new CEO and this clear prioritization, the provocative question for you to mull over is this. How much longer before the Textron name becomes synonymous solely with defense and commercial flight and not its historic, diverse conglomerate roots?
A truly profound question. Thank you for joining us for the deep dive.
We'll catch you next time.